We all know that investing in the stock market is a moving target. However, with risk management, the idea is to mitigate some of the risk. And today we're seeing that risk like never before. Literally, the 60-40 example of a traditional basic portfolio has faltered in ways we haven't seen since before World War II. Let's talk about that right now.
Welcome to the Trending Report, brought to you by USA Financial. The Trending Report is a bi-weekly show that aims to focus on the trend lines rather than the headlines. Each episode features commentary around the state of the market, as well as other factors that may impact your personal finances. The host of the Trending Report is an investment advisor representative of and securities are offered through USA Financial Securities, member FINRA SIPC, a registered investment advisor. The Trending Report is educational and not intended as personal financial advice.
Well, as the saying goes, it definitely is not your father's stock market any longer. As a matter of fact, the 60-40 portfolio example, which has been used for decades going back prior to World War II, has recently faltered in ways that we just literally haven't seen since the 1930s. Now, with that being said, we'll talk about the volatility going on in the market and how it's kind of changing the game, so to speak, in terms of designing your portfolio and using professional management. Also, on top of that, we'll go through the normal data that we always like to review here in the Trending Report, where we look at how the market is being impacted by all things economic, all things market-based, all things political-based, and kind of bringing that all together into some data points. And we'll take a look at it through the lens of capitalization from large cap to small cap, through the lens of sectors, the multiple sectors that make up the stock market. From an international perspective, we'll look at the markets. And then finally, we will also take a look at the bond markets as well. So with that being said, that data was compiled as of November 13th, and let's jump in. As I mentioned a moment ago, the generic portfolio of 60% stocks, 40% bonds is something that the market has relied upon in terms of being a reference point for, gosh, it seems like ever, going back very deep into history, decades and decades, back to beyond World War II, creeping up onto World War I, as a matter of fact. And with that being said, the idea is that if you don't know what else to do with your investments and you just want to kind of take a very generic approach and just hope for the best in the long term on a buy and hold strategy, then 60-40 is where oftentimes, things would point you. Whether you were doing research on this or Googling it, you'll just see reference to this time and time again. Now, the average return going back to 1945 is in about the 9% range for a portfolio like that. In each year, you can see here, these blue bars are when it was up. So here it was up quite high back in a couple of these years. And then the red bars are when it's coming in very low. And the idea is that, generally speaking, if stocks aren't doing so well, then hopefully bonds are, and vice versa. But we're in a little bit of a different environment right now because interest rates have been rising, and that's not good for bonds. Generally speaking, as interest rates go up, the underlying value of the bond goes down, and that has an impact on the value of the bond. At the same time, 2022 was a tough year for stocks. So you got the double whammy taking place. And in fact, it's the biggest loss a portfolio like that would have taken on since the 1930s. So going back quite some time. Now, we are seeing some bounce back this year. So it doesn't mean that this portfolio can't do anything correctly. Obviously, that's not the case. But things are getting a little more volatile. Things are changing in different ways. And it's definitely impacting the concept of a long-term buy and hold strategy where you're not changing the holdings, you're not doing risk management, you're not putting any strategy behind it whatsoever. Now, with that being said, there's another way to kind of look at what's been going on historically in the market, and that is the investment themes that win each decade. So in other words, what subset of the market was really driving things at any given point in time? So here back in the 1950s, it was European stocks. In the 1960s, it was what was called the Nifty 50, which basically was the 50 largest large cap stocks that were existing back then. And you can see what the market kind of was doing at those points in time with that. And then in the 70s, it became about emerging markets and commodities, especially when you were looking at the price of oil and such during the 1970s. And then in the 80s, it became Japanese stocks. In the 90s, it became American tech stocks, or the NASDAQ, as many people remember the NASDAQ really coming screaming onto the scenes thanks to the 1990s and ultimately the tech bubble that hit in early 2000s. And then here in 2000, we had the emerging markets and commodities and oil, so oil prices and such as well. And then in the 2010s, we had what they're calling the American mega caps, most specifically FANG. And FANG is really the technology-based American mega caps. FANG standing for Facebook, Amazon, Apple, Netflix, and Google. Now, there is not an ETF that tracks exactly just those five, because it wouldn't be very diverse, and just boiling it down to only five stocks. But there is an index, or an ETF, I should say, that does track FANG plus some other large tech stocks as well. And this would be a chart going from 2021 up until basically today, and showing you what's happened there. So although this is what was going on in the 2000s, and you can see it starting to change towards the end there, if we take a look at 21 and more current, starting here in 21, well, now we've got kind of a swoop here. That's the 200-day average taking place there. But as you can see, when we look at the trend, the long-term trend was trending down through here. Now it is bouncing back here, but we're seeing a little bit of a slight downturn right there with the longer-term trends going on, but obviously not what it was in this previous screen here. My point being that the 2020s are likely going to be defined by yet another investment theme. And so it's important that you design a portfolio that can take advantage of a changing environment. And that's one of the reasons that we do the things that we do here at USA Financial Exchange and USA Financial Formulas. But that's a topic for you to address with your financial advisor. So I'll leave that to a personal level for you. Now, if we think about all the volatility going on, obviously that's impacting the stock markets as well. So let's take a look at our normal data. Here we're looking at capitalization over the last 12 months. And if we take a look here on this blue bar that we've highlighted, this is the Vanguard Total Stock Market ETF. So it's an overall representation of the stock market. Now, as the trends score higher, they are kind of lifting the market. As the trends score lower, they are kind of dragging the market down. But keep in mind, when we're looking at so much red, so many negative trends, you're not getting a huge lift out of anything. It's all kind of, what is less worse than the other, so to speak, is often taking place here. So from a trend perspective, we're seeing almost all red. But what we are seeing is that the top of the heap here is your very large cap oriented holdings. QQQ is the NASDAQ 100. You've got the S&P 100, the S&P 500 growth and index, and then the S&P 500 value is lagging just a little bit behind. But then down here at the bottom, we're seeing primarily small caps. The small cap 600 for the S&P 500, or excuse me, for Standard & Poor's, not the Standard & Poor's 500, separate thing. And the Russell 2000 is down here, which is your small cap collection. The line we're seeing right through here on the Vanguard Total Stock Market, that's the 200-day moving average. So as you can see, we were ramping up through here, indicative of the longer term trend showing in green down here. But now we're seeing the short-term swings. You can see the red short-term swings coming down. We are getting an upswing right now. Just recently, a small upswing or a brief upswing, excuse me, easy for me to say, has come upon us here as of late. But you can see we've got resistance levels here in the black, and then support levels down here. So the trend had definitely been coming this way until this most recent green swing up right in here. Now, all of that is indicative by this column here. We're seeing the swing, the most recent, all of the market, whether it's large cap or small cap, it's all starting to turn bullish on the short-term swing. So the only one that's got both the trend and the swing showing bullish right now is the NASDAQ 100. Everything else, the swing is starting to lift, and the question will be, will it turn the trend? Now, if we go over to the sectors, here what we do is we take an equal weighting of all the sectors in the middle, and then we look at what's been lifting it. Well, lately it's been gold and telecom and energy and information tech. And then down in the bottom, we see healthcare and consumer staples and real estate kind of dragging things down. Again, somewhat similar viewpoint, but because it's equally balanced, it does change a little bit from the previous screen. But we are seeing some long-term trends here towards the positive, but we're seeing some shorter-term trend coming down this way here, as you can see with the red. We do have a little bit of an uptick taking place right now, but it is been basically a pretty volatile time point after the last year. So if you're taking a look here, we basically started here, we ended here, but it's been kind of a bumpy ride in between. And then if we look at internationals, here on the international side, we're seeing everything red in the trends, but now we're seeing everything green in the short-term swing. So it is very much like the US. It's starting to take a bounce back up. What's lifting the international is Latin America. Here's just a perspective to show the S&P 500 in here for the US up at the top of the charts. And then we got the MSCI over in Europe and so on up here at the top. Down at the bottom, we are seeing some of the small caps and things here, just like we were seeing over in the US, but very volatile ride, as you can see. So we had a long-term trend kind of swooping up on the 200-day moving average taking place here, but then we see the downturn coming in here. Again, we've got support, support, support. And then we've got resistance and resistance, and the trend is kind of going right down the center of that. And then finally, we take a look at the bond markets. Again, we're seeing a lot of red on the long-term trends, but now we're seeing an upturn in the short-term swing. The overall bond market is in this downward trend that we're seeing here, corresponding right up here and bringing it on down. And you'll see on the swings, multiple shorter-term red swings coming down with recently we do have a green uptick in the very recent past here as well. So the markets all are kind of moving the same way, right? The long-term trend is hanging on to its bearish status, but the short-term swings are pretty much all starting to turn bullish. So the question is this just a little blip in time, or are we starting to finally get traction, get our feet back under us, and are we going to turn that swing, have that turn and push and lift the trend with it? And that will be yet to be seen, but we will definitely be keeping an eye on it for you.
Thanks again for listening to this episode of The Trending Report, powered by USA Financial. We invite you to visit usafinancial.com to find out more about our work with independent advisors and their clients all around the country. Any projections, targets, or estimates in this report are forward-looking statements and are based on the firm's research, analysis, and assumptions. Due to the rapidly changing market conditions and the complexity of investment decisions, supplemental information and other sources may be required to make informed investment decisions. All expressions of opinions are subject to change without notice. Clients should seek financial advice regarding the appropriateness of investing in any security or investment strategy discussed.